start off by analyzing Euro USD, and I usually prefer to start with the higher time frame. And my higher time frame, I usually use the daily time frame, and then from the daily time frame we'll go down to 4 hour time frame. From the 4 hour time frame we'll know if we have a setup or not. So looking at the daily time frame for Euro USD, I can see without even doing anything, I can see it's a clear uptrend. You can see the market is forming this higher high, higher lows, higher highs, higher lows, and so forth, going up. So the first thing that you should do when analyzing the markets is you start by asking yourself, what is the market structure? The next thing you want to do is mark the zones, the daily zones where market could turn when it gets there. So what you usually do is you look to your left from the recent price action. Looking at my price action on this chart, to the left, all I can see, the highest point that has not been touched for a long time, there's this one here. So that is one point, the daily zone. We also have another one here, and the other point which can be seen without struggling is this one. So these three are our daily zones, and I usually like to mark these daily zones with these dotted lines so that my chart can be clean. So by now we have started by identifying the market structure, and we have already identified our daily zones. The next thing we want to do is go to the 4 hour time frame and identify the same. Now we are in Euro USD 4 hour time frame, and from here I can tell without even counting that this is an approximate of the 200 to 300 candlesticks, and from this all you need to do is the same thing we did on the daily time frame. You first identify the market structure, and with that it goes without saying that the market structure on the 4 hour is in sync with the daily time frame. They are both an uptrend. We have already established our structure on the 4 hour for Euro USD. So the next thing we want to do is identify zones. And one thing I want to point out clearly is that a trend line for me is also a zone. So as you can see, that's our trend line, and it is being respected very well, as you can see. So zones help us identify where price might potentially turn when it gets to that point. And we have a number of types of zones. We have trend lines, we have support and resistance. So from there, after indicating your structure and your zones on the daily and the 4 hour time frame, the next thing you want to do on the same 4 hour time frame is analyze the structure. And by analyzing, what I mean is point out where the lows are, where the previous high got broken, and so forth. So starting from here, you can see that this high was broken by this candle. So after a candle broke and closed above, we call it a break of structure. So here you can see there's a break of structure, a 4 hour break of structure, giving us a new high. It traded lower, went again, broke the new high, and so forth and so forth. So after analyzing the structure as I have done here, the next thing you want to do is look, or rather focus with the latest price leg that led to the break of structure. And for our case, this is the recent price leg that led to the break of structure, this right here. After you identify the recent price leg that led to the break of structure, you want to look at the demand zones that came just before the structure was broken. So for this case, I can only see 2 relevant demand zones that came immediately before the zone was broken. So let me just mark them out for you to see. So here is our first demand zone, this right here. This one was our first demand zone before price got broken here, and if you go below it, there's another demand zone right here, and if you go below it, you will also see another demand zone, a huge demand zone, this right here. So let me just repeat. So this is another for our demand zone. So before this high got broken by this push phase, we have 3 demand points. We have this, our first demand, our second demand, and our extreme demand point. So what I usually do is, after I establish my demand zones or supply zones, if it's a downtrend, the next thing you want to ask yourself is which zone is relevant for your case and which has like strong confluence within it. Like, you know, you can't just work with one thing. You have to add confluences to your analysis so that you can make them stronger and so that it might work in your way. So looking at this first demand, I can clearly see that it got broken. So if demand was broken, it was violated, so it is invalid for me. So I'll just delete this. It does not make sense to me. And then there's this extreme for our demand zone. It's a strong demand zone, but the problem is it does not align with our trend line. It is way beyond our trend line. So I will just delete this. So I'll be left with one demand zone, which makes more sense looking at everything looking at how price is reacting when it gets there. So as you can see, price traded up to this point, made a new high, and started to come down for a pullback. And when it reached this point, as you can see, this zone, price wicked out the zone, but it never closed beyond the zone. So this makes our zone stronger and stronger and gives us added confluence that the zone is relevant. And as you can see, the same zone is the zone. It's the only zone that came so close to our trend line. So it gives us it gives us more confidence in it. After you are done with the 4-hour time frame, what you want to do next is go down to a lower time frame. The next lower time frame should not be anything higher than 1-hour time frame, and should not be anything lower than the 15-minute time frame. So you can either use the 1-hour time frame, the 30-minute time frame, or the 15-minute time frame immediately after the 4-hour. And the reason why I'm saying this, it's because if you use anything less than 15-minute time frame, there's a lot of noise in that price action. There's a lot going on, so it might misguide you and you might not even get a clean setup. And if you use anything higher than 1 hour, you won't get enough clarity of how price reacted to the zone. From the 4-hour, let's go to the 1 hour and see how price reacted when it hit this 4-hour zone. So we are in the 1-hour time frame, and what I can see, this is the 4-hour zone, this right here, and this is the pullback. This is the pullback, and we want to see how price reacted when it touched the 4-hour zone, and from how it reacts, we can be able to make a trading judgment and place a trade from there, or even find a setup. So this is price as it was coming down during the pullback. You can see immediately after it touched the zone, it had these wicks right here, and after weakening the zone, it went back up and broke the previous high. So as we all know, a change in character, if you're a price action trader, means that the sellers are weakening and the buyers are gathering enough strength to overcome the sellers. So as you can see, this is one indication that buyers are coming in strong. So we all need a confirmation so that we can find a setup. So this right here, the change of character, is an indication that it might happen. So the minute this high again is broken, it's a confirmation that the buyers are now in control. And for me, what I usually do, I don't trade the change of character, I trade the break of structure after a change of character, and this gives me a lot of confidence in my trades. So let me just show you a live example of how I could have placed a trade on this scenario. So as you can see, after this pullback came all this way down, and then we had this pullback which came and broke the previous higher low. That was an indication that buyers can potentially take over the market. And then after it broke this structure, it confirmed that the buyers are now in control. What I usually do is I just come here and look at the demand, or rather look at the demand left by the move. So this is the demand right here, and then I always recommend that your first take profit should always be within your range. And when I say within your range, as you can see, after this structure was broken, this was the highest point price came to. So your first TP should not be anything higher than that point. It should be something like that. And then your stop loss should be below your zone. And when I say below your zone, it is something like this. And then you give it a few pips buffer. The next thing you want to do is look at your risk reward, and from your risk reward, that's where you will know where to put your limit order. So if you like high risk reward trades, or rather if you're not pleased with the risk reward that your trade gives you, all you have to do is adjust your entry point. So if you want a 1 to 2, it's okay with you, then that will be okay for you to put as your entry point. And as you can see, that did hit your TP if you were to put it like that. But if you're not pleased with the risk reward, which is 1 to 2, you can easily lower your entry point until you get the right risk reward. But never move your stop loss. Never move your stop loss or your TP. You know, some of you might move your take profit to illogical points and then hope that price will just come and hit it. But most of the times that price won't even get close to there before turning around. So put your TP to your first range, and then your stop loss a few pips below the zone, and then your entry point, I usually prefer putting it immediately where the zone begins. After doing all that analysis, the next thing that I usually recommend for every trader to do is ask himself, what are the possible moves that price could make from where it is? So price usually moves in two ways. It either moves up or moves down. So from where price is standing at the moment, this is how the price could move. It could either move up or move down, or even play along a range. Those are the only three movements that price could make from this point. So what I usually like to ask myself is, which move am I willing to take advantage of, and which one makes more sense to me, and which ones has the most likelihood of moving in my favor. So if you look at these three scenarios, you can see that if price goes down, before it even breaks this zone, it will have to wander around here. So it will either reach this point and go up, or even reach this point, break it, retest it, and trade even lower. So you ask yourself, which move am I willing to take advantage of? So the first move I would really get rid of is the consolidating move, because you can't get a good risk reward, and it's not really predictable when you're trading a range market. So I will just delete this move. So I'm not willing to get involved in the market if the market moves in that way. So we delete that. So we are left with these three moves. The market will most probably move either up, move down, and when it moves down to this zone, it will either go up and continue following the trend, or break the trend line, retest it, and change character and start trading low. So for me, I usually like to follow the direction of the trend. So it will be only good for me if I utilized this move right here. So I will be willing to take a trade if price comes back to this zone, and if price continues to trade higher, I am willing to stay out of the market until this 4-hour zone is broken. So it's either I wait for price to come all the way up, break this zone, I will enter that position, or come back down, get to this zone and show me every and I get a nice reaction of rejection on this zone. So that is my Euro USD setup for the week, and that's it.